In today's session, we're going to take a look at alternative methods of valuing a stock. One of the best known, one of the most reliable methods is dividend valuation or discounted dividend valuation methods. We're familiar with this approach from earlier courses in corporate finance where we looked at the Gordon's growth or the dividend growth model, or the dividend discount model it's called as well. Today's session we're going to take a look at when the dividend discount model is appropriate for valuing a stock. We'll look at how we calculate the dividend discount model. We'll see again Gordon's growth model using dividend growth as part of the model. From this we can kind of reverse engineer the implied growth rate for the dividends, and we'll take a look at a special case, dividend growth models with negative growth firms. We'll also take a look at how we can estimate the present value of growth opportunities. We'll look at how the dividend discount model is also associated with the price earnings multiple, how we understand required rate of return. We'll introduce the ideas but not get into detail on multi-stage growth models or non-constant growth models, and the Halflife model or the H model. We'll talk a little bit about how we can use this model for a non-dividend paying stock, and we'll talk a little bit finally about how we forecast growth. So first off, when is the dividend discount model, when's Gordon's growth model appropriate for valuing a stock? The best cases where we use this model are for companies that regularly pay or are expected to pay a dividend. The firm's directors typically have established a consistent, understandable, well-communicated dividend policy, and they tend to be able to achieve their objectives. Often, investors who are more interested in income use this model. It's not about valuing a company for acquisition. It's not about control. We do see that there is a regular dialogue, especially in the internet, about firms that regularly provide high levels of dividends. Some of the best known high dividend stocks are ones like McDonald's, PepsiCo, and Visa. And in this particular article that I just happened to notice on the internet, and I could probably find 100 other variations like this, analysts will regularly point out that certain companies are persistently capable of generating higher than average returns because they pay regular dividends. These 5 stocks are identified as ones that have done particularly well. If you put $20,000 into an average Standard & Poor's 500 firm 10 years ago, that $20,000 would have turned into about $63,000 today. However, if you would have put it into a high-yielding, high-dividend firm like McDonald's, it would become more like $100,000, significantly outperforming the average. Visa, $231,000, Caterpillar, $95,000, and so on. All of these are wonderful success stories. Although a critical analyst is going to look at this and say, well, wait a minute, these weren't just randomly selected companies. These are high-yield firms, but were all high-yielding firms capable of producing these returns? And the answer clearly is no. So this is actually a good example of selection bias, choosing companies as examples because they meet our particular objectives for the argument. Although you can see that there are many firms that regularly provide high dividends and are predictable. From this particular table that I found on Seeking Alpha, they're described as dividend kings. Sometimes they're also described as yield hogs, or at least the investors who buy these dividend stocks are called yield hogs because they purchase the stock because they have high dividend yields. We'll come back to dividend yields in a second. That's quite important. But just looking at these examples, the dividend yield for companies like Altria, who we saw on the previous slide, Lowe's, Target, 3M, Emerson, Johnson & Johnson, Colgate, and so on, these are the top yielding U.S. stocks, or among the top yielding U.S. stocks. They come with high dividend yields and high overall yields. Of course, the overall yield comes from price appreciation as well as dividends. We have, in the case of Altria, for example, about a 6.8% dividend yield. A very high dividend relative to the share price. Or just to remind you, when we do use the term dividend yield, that term essentially comes from the calculation of the expected dividend or predicted dividend over the current share price. There are two ways we can create high dividend yield. We can have high dividend, obviously, or we can have a low share price. And in some cases, dividend yields are rising because the share price is falling and our expectation of dividends are holding straight. So falling market prices tend to make the high yielding stocks or high dividend yielding stocks look more attractive. The other way that companies return capital to their investors is through buybacks. And Lowe's, for example, is a great example of a high-yielding company that provides a lot of the yield by buying back their own shares. Although we will see a lot less of that in the coming years because there may be restrictions because bailout money won't be available to firms that are doing buybacks. So these are some interesting examples, as I said, of companies that provide high dividend yields. For comparison, the average dividend yield last year for U.S. stocks was about 2.2 or perhaps 2.3%, and a little bit higher in Canada, higher than that in Europe. So dividends have become relatively small part of the total returns on average, but for some companies, much higher. The ability of companies to pay dividends depends on the stability of their earnings. And you can see in this example from the equity markets textbook, we have a case of two companies, Coca-Cola and Hormel. From the years 1992 right through until 2006, you can see that Coca-Cola had earnings per share that range from negative values up to about $3.40. There's a certain amount of variability in the earnings. However, take a look at the dividends per share. Coca-Cola decided that we're going to try to maintain a relatively consistent level of dividend in dollar terms. And the payout ratio, on the other hand, is what we see varying. So in some years, perhaps the payout ratio was almost 300%. In other years, it was closer to 40%. So the management at Coca-Cola have essentially said, we know that our investors expect to receive a dividend of $1 per share per year. We know that our returns are going to be volatile, but we're going to give them something they can bank on. And that becomes part of their constituency. People are going to say, I like to invest in Coca-Cola because they give me a steady dividend. Other investors might not see the same interest or have the same interest in consistency at all. Compare that to Hormel. Their policy is clearly different. Their earnings per share, that's HRL is Hormel, their earnings per share varied quite a bit. They went from, about 50 cents per share up to about $2.05. And we even see a trend, an increasing trend throughout. Their dividend varies every year. It goes up, it goes up, it goes up. Occasionally it goes down. So they've allowed their dividend to vary every year, but what we actually see is their payout ratio remains more constant. So in both of these cases, they're relatively high dividend stocks, but in some cases the dividends are very predictable. In other cases, the payout ratio is predictable and not the dividend. This helps us to understand the kind of companies that we're looking at when we're trying to understand how to use this particular valuation model. The model can be applied, and it has been applied, as one of the oldest and most accepted methods of equity valuation. If we want to know what a company is worth today based on its cash flows over the next year, we'd say we expect to receive two specific cash flows. We expect to receive the value of the share at the end of the year, P1, the amount of money we'll receive at the end of the year. And also at some point during the year, we're going to receive a dividend for the year, D1. That's our predicted dividend for the year. So we could say that the value of the stock today is going to equal the sum of the present value of the dividend and the present value of the eventual selling price. And for example, if we had a 10-cent dividend and a $1 share price, we're going to receive a total of 1.1 as our cash flows from the stock during the year. If we're going to, say, discount it at a cost of equity, and remember this is cost of equity, not cost of capital, because you're investing in equity when you buy the shares, not investing in a whole company. So we only use R sub E in this particular shorthand. So if we had a 10% cost of capital, $110 over 1.1 essentially says the price today should be $1. More commonly, we're going to use this model to be able to value a company over a longer period of time. And in that case, we take a look at a stream of cash flows, a stream of dividends that are going to be received for over many years, followed by eventually the expected selling price of the share at some point in the future. So in this case, the value of our company would equal $2 in dividend this year, $2.10 the next year, $2.20 the next year. And in the third year, we're also going to sell the shares, or we expect to sell the shares, for $40 a share. If we're going to value this company, discounting it at 10% cost of equity, that would give us a present value of the cash flow dividends today of $182, $174, $165, and in the third year would also sell the $40 share for a present value of $30.05. You shouldn't pay more than $35.26 for this company. As a practical application, this isn't going to really work for us because we don't know with certainty what these cash flows are going to be, and we certainly don't know what the value of the stock is going to be. But once we understand the model, we can start to apply it in more interesting ways. If we're taking a look at the growth in these earnings, we also have an interesting problem trying to be able to predict the growth. We know that growth comes from several sources. Some of it comes from market, some of it comes from inflation, and some of it comes from the ability of the company to be able to expand its interests. The market itself, and again, this is a table from Chapter 3 in the Equity Asset Valuation, which is one of the key reading resources that covers this part of the course material. We can see that countries tend to have a fairly predictable annual rate of growth over longer periods of time. It may go up and it may go down with recessions and expansions in those other economies, but typically countries are going to be constrained to grow within certain boundaries. If you're in a well-developed country like Germany, France, or Italy, expansion is largely predicted by the ability of the country to increase overall productivity, typically through technology. If you're in a growing country, a resource country especially like Australia or Canada, your growth is going to be restricted by productivity, but also by the ability to find a workforce to be able to produce your product. And that means that immigration may actually increase your capacity to be able to grow your economy. If you have an underutilized workforce, that may be a part of it. When we look at China, for example, from, as I said earlier, from the late 1970s right through until about 2010 or 2011, the economy was able to grow quickly because it had a lot of underutilized resources, a lot of people who weren't yet working in the commercial economy. So how fast can your company grow? One of the things that's going to help us to predict that is the growth in the economy. So if we say that we expect our economy is going to grow by 3% next year, then that may be a big part of the overall prediction of long-term growth in our dividends. Growing faster than that becomes a bit problematic, as we'll discuss later. One of the things that I mentioned earlier was that we have investors who are very interested in dividends. A particular group of investors see the dividend as one of the best predictors of overall corporate value. Dividend yield goes up when share price goes down, so typically we can find high dividend yielding stocks in slow growth companies, and companies that are capable of generating large positive cash flows and producing predictable long-term returns. So it's not just high dividends, but predictable dividends that become a key to what we're looking at. These investors are often called yield hogs. If we want to know more about dividends, there are a number of sources we can use. On a charting system called Big Charts, we can see that by asking for information about dividends, if we go into the chart and we specify that some of the predictors that we'd like to see or indicators that we'd like to see are earnings changes and dividend changes and stock splits, when the chart produces information for us, it gives us certain highlights. So you can see on this chart, for example, that we have these D's and E's. And an E in an upward triangle means an earnings announcement higher than expected, earnings up. And the D represents a dividend that's going to be declared and then later on paid out to the shareholders of record on that date. So the dividends, if they're regular, if the dividends show a regular improvement, then we're going to have a stock that essentially is going to be something that's very popular with investors and see a higher share price. In this case, we're looking at Toronto-Dominion Bank, and the Canadian banks are remarkable for their ability to produce regular high dividends. Now, it's also possible to use a dividend model if we're looking at a firm with negative growth. Imagine companies that are in the mature stage or perhaps in the decline stage. They're not expanding their business. In many cases, they're winding down their business, and they're generating positive cash flows. What do they do with their cash? They can't reinvest it in the business because they're trying to wind it down. So they pay it out as a dividend. We see great examples of this. Companies like, if you remember Blockbuster Video, as people stopped renting videos and VHS tapes from a store, eventually we ended up with, I think, only one Blockbuster store left in existence, and I think it's someplace like Alaska, where the very last Blockbuster store exists. If you were an investor in Blockbuster, you could see that every year the company was shrinking a little bit. In this case, we're talking about a mine. And again, from the equity asset valuation text, in this case, Afton Mines, they're profitable, they're producing a regular dividend, but because the mine is getting tapped out, they're eventually going to see the mine shrink down to nothing. They say that the rate of decline is 10% per year. So in a model like this, where we typically use the familiar model that says the value of the company, the value of the company is equal to D1 over R minus G. If we have a discount rate or a cost of equity of 12%, our required rate of return is 12%, and our growth rate is minus 10%, then the value of the company is 4.25, the expected dividend, divided by 0.12 plus 0.1. And that's where we get the 0.22 in the denominator. So the overall price, or the intrinsic value of this share, would be $19.32. The growth rate is going to be linked to things like sales. A company's sales increases by 20%. We don't automatically see its profits and its operating profit, its net income, even its cash flow. We don't see these things rising immediately, but they tend to follow. So an increase in sales usually comes with an above average increase in costs, so the income will slowly follow that. And then it takes a little bit longer for the cash flow to catch up, and eventually cash flow is what we pay our dividends out of. So the growth in dividends will be similar in the long term. In a balanced, harmonized model, it'll be similar to the cash flows and earnings, but it won't be perfectly and exactly the same. In Gordon's growth model, if the model affects the share prices, the growth is also going to affect the share price. So our model, as we said in the previous slide, the dividends, last period's dividends times 1 plus G to get D sub 1, the predicted dividend, over R minus G. And in this example, if we have a $40 value for the business, and if we want to know what the expected or the implied growth rate is going to be, all we have to do is solve, once we know the current dividend level and the required rate of return. So here, if we have a 12.2% required rate of return or cost of equity, and we want to know what our growth rate is, we would do this algebra stuff and solve for the things that we do know. And we do know that that 0.22 divided by 0.122 plus 40 times g is equal to 2 plus 2g, and then we solve for that. We get 42g is equal to 2.88, so therefore g must be 6.86% or 6.9%. We can plug that into the model and check it, and yeah, it works. So if we don't know what the growth rate is, if we know what the share price is today, and we know what the required rate of return is, we can say what the market expects the growth to be. We can also test that against reality. For example, in the 1990s, when they privatized the electricity companies in Britain, the rate of return that was provided to the firms was largely decided by government bodies, including some of my ex-students who were working determining what they called the K factor, which was the fair rate of return to those electricity companies. Then those companies would use that K factor and the amount of capital they had employed in the business and the cost of the fuel that they used for the electricity to determine what the fees would be for the users of the electricity. So we pretty well knew what the rate of return would be. When we actually took a look at the share prices were very high for that level of rate of return. The only way that could be explained was to have a high growth rate. And that didn't make sense because the growth in the electricity business is limited by the amount of capacity that they have. Unless they build new plants, how are they going to grow their business? It also put a lot of pressure on management to create that growth. And they did it in some of the most amazing ways by expanding into businesses in overseas markets, sometimes without having done much research. And it created some massive disasters. Investments in developing countries where the electricity was badly needed, but where the business models weren't working and where the infrastructure wasn't available and where the legal system didn't provide them with protection. So this value of G is determined by the exuberance of the market as much as anything, not just our guess of what growth should be. Another term that we use quite often is the value of the growth opportunities, or the present value of the growth opportunities, PVGO. And that's the expected value today of opportunities to invest in or put money into investments that's going to create future earnings. So essentially, share prices are going to equal the value of the stocks without earning reinvestment. We pay out all the earnings, and the present value of growth opportunities. And typically they're positive, but they could also be neutral or negative. Now, you could say, or we would say, that the value of a company, by rearranging the terms we've looked at earlier, is equal to essentially an earnings yield. If we have, for example, earnings per share of $1 and 10% cost of capital, that would be $1 divided by 0.1, which would be 10. And so that would be the value of a perpetual stream of earnings. We talked about the value of a perpetuity in MBA 521. We'll come back to that more in this course. But $100 that's going to be paid out every year until forevermore, $100 divided by 0.1, essentially has a present value today of 1,000. That would be the value of a perpetual stream of $100 cash flows. The difference between the value and the value of that perpetuity then has to be the present value of the growth opportunities. So, for example, if we have a company that generates a regular dividend or regular earnings per share of $1.75, we have a required rate of return on capital of 0.1, 10%. Then that means that the value of the value of that perpetuity is going to be $17.50. We're $7.50 different from the $25 So therefore, the present value of our growth opportunities is $7.50. And it says, here's our company. It's worth $25. That value is made up of two parts: the stream of returns to the existing business, that perpetuity, plus the potential. And the potential in this case is $7.50. You could say that about you and I. If we take a look at an old guy like me, and I have relatively high earnings at this late stage in a career. I have a regular or expected discount rate, the rate at which I replace my capital, which say the average return to a market portfolio, and that essentially tells you what the return I'm getting from my work this year is going to be. However, the remainder of my value is going to be the value that I'm going to earn for the rest of my career. And if I only work for another 5 years or 10 years, that is going to be relatively limited. A worker who's entering the market and earning a small amount of money has got a small yield from their current activity, but the present value of their growth opportunities would be so much higher because they'd have many more years to work in the market. So this would be a big difference between a company that's in decline and a company that's in a high growth market, in a high growth business. Here we can compare some interesting examples. And again, from equity asset valuation, Google, McDonald's, and Macy's. I'll look at the first and the last as great examples. Google is a company which has been doing very well at creating value. We can see that from this table, some of the key bits of information that we have: their earnings per share, $15.88, their discount rate, or the cost of equity, 13.7%. And so from that information, the E over R gives us the value of the perpetuity. It says in perpetuity, Google produces a value of 115.91. That's the present value of their earnings if they continue in the current vein. Their share price on the day that this is taken is $332. So there's a $216 difference between the value of that perpetuity and their share price. And that means the market must be valuing their opportunities at $216. The present value of their growth opportunities then 65% of their overall value. Compare that to Macy's. Now, Macy's is not doing well at the moment. In fact, when this textbook was last edited, it wasn't doing very well then either, because they had a $1.30 value earnings per share. They have a discount rate of 10%, safe and stable business, but not a fast-growing one. Their share price, the value of the perpetuity then, 10.1 divided by 1.3 is $12.87. Their share price was $10.50. That means the present value of their growth opportunities was negative $2.37. So clearly the market did not like the growth potential for Macy's. They say Macy's is worth money because it generates regular stream of earnings, but we don't expect it's got a high value for the future. And of course, we're not really looking at Macy's as a great investment right now. They say Macy's may not even survive. I don't know if this ad was selected because it was particularly gloomy. We've seen other companies go broke in the last couple of weeks, like Neiman Marcus. And they say you should perhaps look for an opportunity to sell Macy's stock, because it's definitely one that may not survive the market, and if it does survive, its growth prospects are not good. One of the other terms that we use to describe most companies, whether they're high growth or not, is a price earnings multiple. And we know that the companies with the greatest growth opportunities have the highest price earnings multiple. We expect a lot of the value will be achieved in the future. That's why the price is so much greater than the earnings relative to a more stable company. So the present value of growth opportunities is determined by the firm's opportunities to invest, and we get some of these, or we can recognize some of these opportunities by using specialized financial tools like real options. Real options work like financial options, and I do try to talk about these in our corporate finance course, although often we don't have the time. A real option essentially is priced like an option, and it's based on the volatility, the uncertainty of the opportunity. The greater the uncertainty, the greater the value of an option. Some of these options that we describe in our real options course would talk about things like the ability to make decisions, to shift the direction of the organization quickly with low cost. So increased managerial flexibility, an option to enter into a new market, and an opportunity to back off and reduce our overheads by getting out of leases early, for example, would be another opportunity to create a real option. Whenever an option exists, it's an opportunity to do something. An opportunity to do something, an opportunity not to do something, an opportunity to scale up or scale down our endeavor. So that would be one way that we'd look at this. In the price-earnings multiple, we see a good example of how this works. Essentially, price-earnings multiple is going to give us an idea of the value of a company, the value of a business, with and without growth. The first part of our equation, 1 over r, essentially is going to be a measure of the capitalization rate, or the rate of return for a company with no growth. The present value of the growth opportunities divided by the earnings per share essentially is going to be the value of the growth opportunity. So 1 over r is the stream of income, the value of a perpetuity, or the factor for a perpetuity for a no-growth company. The model can also tell us something about the effective discount rate that we're using, or the riskiness of the business. We've seen how this can be used to calculate the rate of return on equity if we don't have the information that we need to be able to use the CAP-M model. We discussed that in our corporate finance course. The two types of return, or two types of two sources of that risk are going to be the yield of the dividend. So that's where we have D1 over P0. So what is the dividend yield? And what is going to be the growth in the business? Together, those things tell us about the required rate of return, or the rate of return on equity. So, for example, if we have a company that has got a predicted dividend at the end of this year of $2.36, and we have a current share price today of $56.60, and we have a 5.5% or 0.055 expected rate of growth, then from this we can solve the discount rate and see that the required rate of return on equity is 9.67%. And it comes from two sources. About 2/3 of that comes from growth, and 1/3 of that is coming from the yield. In corporate finance, we spend a lot of time looking at companies that are expected to grow at a high rate for the next few years, the next few months, at a moderate rate for the period after that, and then from the end of the second stage to perpetuity, that firm might grow at a slower rate. That's, for example, why we use the terminal growth rate in a valuation model that we did earlier in corporate finance, essentially creating a two-stage model. We could have different rates of growth in each of the periods up to the horizon, but from the horizon to perpetuity, we use a terminal growth rate, because you don't expect companies to grow at a really high rate forever. Ultimately, those companies would become the entire economy if there's not going to be some point at which they start to normalize their growth. At Aswath Damodaran's website at New York University Stern School of Business, he provides a lot of different models that are applied for many different purposes. There's a 2-stage model, a 3-stage model. In a 3-stage model, for example, there'd be the high growth period that would happen for the next few years, followed by a transition stage, followed by a stage at which the company perhaps grows at the rate of growth of the economy. And that would give us a way of valuing that business according to the different types of growth pressures. So the idea of this is that companies can grow at a fantastic or a supernormal growth rate only for a short period of time until a particular opportunity has been capitalized on. But the valuation would be silly if we went beyond that period of time, because companies eventually are going to slow their growth. We've seen this happen in the past with famous high-growth companies like Intel, Apple, Microsoft, and we'll see that in the future with other companies like Amazon that are in the current high-growth phase. There's another version of this model that's perhaps a little bit smarter in many respects. It's called the H model, or the Halflife model, essentially where there's considered to be a supernormal growth period at the beginning in the first stage, and then that will get stepped down by halves as we go beyond that first period. So we'll go to a half of that growth, a half of that growth, and so on, until eventually we reach a normal rate of growth. So that's a model that we don't specifically look at today, but it's one that's covered in Chapter 3 of the equity textbook. You can apply the principles of the dividend discount model to a non-dividend paying stock. And you remember at the beginning I said we can expect that a company is going to see growth in sales, growth in earnings, growth in cash flows. Well, those cash flows are used eventually to create dividends. So any returns that a company gets will eventually be passed back to the shareholders, either through share repurchases, through dividends, sale of the company, sale of their shares eventually. So whatever returns we see going into the company will eventually become part of the value creation proposition. Companies are increasingly using share repurchases to return money to their investors. But it's not the actual dividend that counts then, it's the ability to pay the dividend. It's the critical factor. So sales growth leads to profit, profits lead to earnings per share, lead to cash flow per share, eventually can be used as dividend. For that reason, instead of using the dividend or predicted dividend for each year in these models, we could substitute earnings per share instead. It doesn't work perfectly. The timing is going to be off by a little bit, but still, this is an alternative way to use the dividend discount model in markets where either we don't have dividend-paying stocks or where the dividends are not predictable. A big part of what we've talked about today has involved growth. And forecasting growth is going to be an important part of every analyst's skill toolkit. You can see that brokers' reports spend a lot of time talking about their forecasting growth and earnings per share, dividends per share, so that they can validate their forecasts and their valuations for the companies that are predicted. As I have always said, at the limit, companies can only grow as fast as the economies in which they occupy, or else they're eventually going to become so big that they're going to become the whole market. You could say that about Amazon right now, that at the rate that it's growing, the rate that it's expanding into other lines of business, eventually there'll only be one business in the world, and that's Amazon. Of course, we know that's not going to happen because regulators are concerned already about antitrust, and so they're likely to cause regulation to stop companies from expanding and taking over their competitors. Also, new entrants are likely to come in and copy the business model or improve on the business model. So we'd say that in the long term, the growth of the firm should approximate the growth of GDP in the markets in which they're occupying. If you're a Canadian company, then 3% historically look like a really high rate of growth. If you're in China, 3% would have been a low rate of growth until recently, and now perhaps 4 or 5% is probably looking more fair. And in the very long term, even China will start to grow at a much slower rate. We can see the historical patterns of growth. We get this from organizations like the World Bank and the OECD. They make predictions about growth, they track growth, and their models are carefully adjusted for things like the differences in which we spend our money. But their predictions, for the world economy have tended to be more stable than we've seen recently, but we'd expect to see a rate of growth worldwide on average of about 2%. Beyond that, I would say that the economy can probably only grow through inflation. Productivity is a big part of that growth story. Use of underutilized resources, of people, of capital. But in the end, an overall growth rate beyond 2% starts to look too optimistic. So, would say in summary, got to have a picture of a cute little piggy in there to remind us about the yield hogs. Dividend-paying stocks are becoming more rare, especially in developed markets. And dividend yields of those stocks have also become lower, but for certain kinds of markets, bank stocks, utility stocks, we expect to see regular dividends, and those type of stocks have established a kind of a cult following. Investors, hedge funds that focus almost entirely on dividends and dividend yields. Later on, we'll take a look at a couple of anomaly prediction tools that specifically look at dividend yields as a way of predicting share price appreciation. Dividend models can be used to value both dividend-paying and non-dividend-paying stocks. They can also be used to help us to determine what the present value of the growth opportunity is and make a decision whether or not the company is overpriced or underpriced based on the amount of that present value of the growth opportunities. They can also help us to be able to determine what the required rate of return is if we know those other factors. We see that there are single factor, single period models, single factor multi-period models, and multi-stage models as well. The Halflife model, which we didn't get into today, can also be used. And one of the main messages that we take away is that all of these models are determined by our forecasts of growth. This is a great year for trying to be able to forecast growth, because at the moment we're looking at some of the most significant drops in GDP growth in developed economies that we've ever seen, going back to the Great Recession, perhaps even earlier. So forecasting growth after this period is going to become a more interesting challenge. One of the other things that I mentioned earlier, beware of any long-term growth forecasts that are greater than the expected growth in the economy. That's it for today's session. I hope you enjoyed this and look forward to seeing you in the next video.